Imagine waking up to find that your bank's net worth, the actual tangible book value of the company, just plummeted by 66% in a single quarter.
Yeah, that's the stuff of nightmares for an investor.
Right. I mean, you go to sleep thinking your slice of the pie is fundamentally worth over $14 a share, and you wake up to find the math now says it's worth, well, less than $5.
Exactly. It's just a brutal reality check.
It really is. So welcome to our Talk Tickers format for the deep dive. Today, we are pointing our microscope at BayFirst Financial. The ticker is BAFN. We are digging into their Q2 2026 earnings call transcript. And look, this is not a standard quarterly update.
No, not at all.
And this is a corporate rescue mission unfolding in real time.
Yeah, we are looking at a quarter that includes, well, a massive net loss, the complete abandonment of an entire national lending division, and a multi-year accounting restatement.
Which is always a huge red flag.
Oh, absolutely. The market's initial reaction to a report like this is always just sheer panic. But the data underneath those headline numbers, it tells a much more complicated story about a balance sheet being surgically reconstructed.
Right. And our mission today is to cut through the chaos of this Q2 report, strip away the Wall Street jargon, and answer the ultimate question for any retail investor holding this stock or watching from the sidelines. Is BayFirst Financial a falling knife, or is this the brutal but, necessary birth of a turnaround play?
That's the multi-million-dollar question.
Okay, let's unpack this. The raw data at the top of the release is a massive yikes moment. BayFirst reported a net loss for the second quarter of $32.7 million.
Ouch.
Yeah. That translates to an $8.05 loss per diluted share.
Right. And just to put that in perspective for folks, that is a staggering amount for a community bank of this size.
Exactly. And because of that, tangible book value dropped from $14.22 at the end of Q1 all the way down to just $4.82 per share.
Yeah. That kind of overnight equity destruction, that is what triggers indiscriminate selling. Investors see that and they just run for the exits.
I would too. It's like ripping off a massive, incredibly expensive Band-Aid all at once.
That's actually a great analogy.
Yeah.
But to understand the true state of the bank, we have to isolate that $32 million hit. If you look at CFO Scott McKim's breakdown on the call, he reveals that almost the entirety of this loss is tied to one-time, non-recurring charges.
Okay, so it's not the normal day-to-day business losing all this money.
Right. These charges are meant to clear out legacy toxicity. So the total pre-tax loss for the quarter was roughly $44 million, but $43.8 million of that was driven by an asset resolution plan, severing vendor contracts, and essentially paying off the old management team to leave.
Wait, paying them to leave?
Yeah, changing control payments, basically severance to get them out the door so the new team can clean up the mess.
Wow. Okay, so if you strip out that noise, what does the actual business look like?
Well, the core operating loss for the quarter was basically break even. They lost just $200,000 on actual daily operations.
$200,000? That's practically a rounding error compared to $32 million.
Exactly.
So the day-to-day business of taking in deposits and making loans didn't really hemorrhage cash at all. They essentially wrote a $43 million check to buy their way out of past mistakes.
That's exactly what happened. And when you look at the primary engine of a bank's profitability, which is the net interest margin, or NIM, the numbers are surprisingly robust.
Okay, break that down for us.
So the reported NIM ticked up to 3.48%. But McKim noted that on a normalized basis, so excluding the friction of this massive asset dump, the margin actually sits at 4.07%.
4.07. Is that good for this current environment?
It's excellent. For a community bank in this interest rate environment, a NIM over 4% indicates really strong underlying pricing power.
Oh, wow.
Yeah, the core banking mechanism is functioning efficiently. It was simply buried underneath the financial wreckage of the old business model.
Which brings us to the $41.5 million question. We know they took this massive hit to clear the decks, but what exactly was the infection they were treating?
Right, the root cause.
Yeah. The transcript points directly to the complete shutdown of their legacy SBA 7A lending division. They dumped $41.5 million into an asset resolution plan to deal with a portfolio of over 7,000 legacy loans.
Yeah, and this is where it gets really interesting. The old management team built this high-volume national lending machine. They were heavily reliant on specialized SBO products they called Bolt and FlashCap.
Bolt and FlashCap. Sounds like fintech, not a local community bank.
It really does, right? These were smaller balance expedited credit lines. And the catch is, while the Small Business Administration guarantees a significant portion of these loans, the bank retains the credit risk on the unguaranteed portion.
Ah, okay. So if the loan goes bad, the government covers some of it, but the bank is still on the hook for the rest.
Exactly. And BayFirst was projecting wildly optimistic assumptions about default rates on that unguaranteed slice. They assumed these businesses would just keep paying.
But they didn't.
No, they didn't. The new management came in, stress tested those assumptions against the reality of the portfolio, and realized they were sitting on a mountain of bad debt.
Right. And the provisioning numbers are just staggering. They recorded a $29 million provision for credit losses this quarter. That's up from just $3.4 million in Q1.
That is a massive jump.
It is. Their total allowance for credit losses is now over $45 million. They are reserving 32.8% against the unguaranteed balances in the bulk portfolio and 25% against flash cap.
Yeah.
I mean, they're mathematically assuming a third of that specific unguaranteed capital is permanently gone.
Which forces a hard pivot. New CEO Alfred Rogers didn't just come in and, tweak the underwriting standards. He killed the entire SBA 7A business.
Just totally shut it down.
Yes. They are winding it down, aggressively reserving against the remaining exposure, and guaranteeing that this specific loan portfolio cannot surprise them with future earnings misses. Taking the hit all at once establishes a definitive floor.
But taking the hit exposes something far more concerning. It wasn't just poor underwriting.
No, it wasn't.
The transcript reveals they actually misstated their financials for all of 2024, all of 2025, and the first quarter of 2026.
Yeah, that's the part that really spooks the market.
Right. They systematically understated their provision expenses and overstated their net interest income by millions.
And the mechanics of the error, they come down to how they handled distressed assets. So as of late March, they identified nearly $5 million in deferred origination costs and accrued interest attached to loans that had already failed.
Wait, they were accounting interest from loans that were already dead?
Pretty much. Banking regulations require that when a loan goes 90 days past due, it moves to non-accrual status. And when that happens, you must reverse any unpaid interest you previously claimed as income.
So you have to give that fake profit back, basically.
Exactly. But the old regime failed to properly migrate these toxic loans into non-accrual. So they were artificially inflating net interest income and artificially depressing the reserves required to cover the eventual losses.
Here's where I have to call out the fundamental flaw in the turnaround narrative, though. If the internal controls were so porous that the bank published fake profitability for over 2 years, why should retail investors trust the spreadsheet that Alfred Rogers and Scott McKim are handing us today?
That's a totally fair question.
I mean, a restatement destroys institutional credibility.
It does. But what's fascinating here is the credibility doesn't come from the institution's history. It comes from the sequencing of the new management's actions.
Okay, how so?
Well, Alfred Rogers recognized the balance sheet was compromised almost immediately upon taking over. This is precisely why he orchestrated an $80 million capital raise back in April, well before releasing this disastrous Q2 report.
Ah, I see.
He knew the accounting was flawed, he knew the SBA portfolio was toxic, and he knew that exposing those realities would require recognizing a loss so severe it could threaten the bank's regulatory standing.
So he secured the war chest before he detonated the bomb.
Exactly.
Because that April capital raise pushed their Tier 1 leverage ratio from a highly precarious 5.89% in March all the way up to a fortress level 8.3% by the end of June. And that is after absorbing the $32 million net loss.
Yeah. This is textbook kitchen sinking.
Kitchen sinking. Explain that.
It's when a new CEO has every incentive to make their first quarter look as apocalyptic as legally permissible. You throw in the kitchen sink, you flush every piece of bad debt, you recognize every impending expense, and you assign all the blame to the outgoing executives.
Whom they literally paid to leave.
Right. It resets the baseline so low that generating a modest profit in the subsequent quarters looks like a managerial triumph.
That makes a lot of sense. So with the old toxic portfolio finally burned down, the obvious question is how this bank intends to generate revenue tomorrow.
Right.
Management guidance points to a total rejection of the national lending strategy. They are retreating to their home turf in the Tampa Bay and Sarasota markets. They hired a new chief banking officer, Trey Korhn, specifically for his local commercial real estate connections.
Yeah, that's a key hire.
And they are opening a 12th retail branch in South Tampa this September.
It is a deliberate regression to traditional community banking. And to fund that local commercial lending, they are entirely reconstructing the liability side of their balance sheet.
Which means the deposits.
Exactly. Total deposits dropped 8.9% during the quarter, landing at $988.9 million. Now, while a near 9% deposit drain usually signals a bank run, the transcript confirms this contraction was engineered by the new management team.
Engineered. They intentionally shed almost a tenth of their deposit base.
They did. Because the old national lending machine required massive liquidity at lightning speed.
Yeah.
This forced the bank to rely on what we call hot money.
Hot money, like brokered deposits.
Right. Brokered deposits and high-rate promotional CDs. This kind of funding is like expensive rented scaffolding. It holds the structure up in an emergency, but you pay a premium for it. And the moment a competitor offers 1 basis point more in yield, that capital vanishes.
It's not loyal capital.
Not at all. So by abandoning the high-volume national loan growth, they no longer needed the scaffolding.
And CFO Scott McKim confirmed they actively pushed out those high-rate brokered balances. The immediate mathematical payoff is huge here. Shedding that expensive hot money drove their overall cost of funds down a massive 24 basis points in a single quarter.
Yep.
It's down to just 2.66%.
And that 2.66% cost of funds is the mechanism driving the 4.07% normalized net interest margin we talked about earlier.
Right, because their costs are so much lower now.
Exactly. By pouring a permanent concrete foundation of core, relationship-driven local deposits, they drastically lower their funding costs, they de-risk the balance sheet, and they lock in a wider spread on their local commercial loans.
And we are already seeing evidence that the commercial relationship strategy is gaining traction. COO Robin Oliver highlighted a 75% year-over-year increase in Treasury fee revenue.
Which is huge.
It is. For those who might not know, Treasury management involves complex corporate services like payroll routing, wire logistics, fraud protection that banks provide to larger commercial clients for a fee.
Which is non-interest income devoid of credit risk.
The best kind of income.
Truly. But more importantly, Treasury services represent the ultimate sticky deposit. Think about it. When a middle market company relies on your banking infrastructure to process its daily payroll and vendor payments, they keep their primary operating accounts with you.
Oh, because it's too much of a pain to switch banks.
Exactly. Those accounts hold massive balances and demand very little yield. Growing Treasury fee revenue by 75% proves BayFirst is successfully capturing those lucrative, low-cost operating accounts from local businesses.
Okay, so we have the mechanics of the cleanup and the blueprint for the new strategy. That brings us to the bottom line actionable takeaways for retail investors.
Right.
Management is forcing an immediate, highly aggressive capital decision on existing shareholders. They are launching a rights offering in August to issue 4.1 million shares at $3.50 a share.
And that's available to shareholders of record as of May 12, 2026.
Yes. So how should an investor view this?
Well, the pricing of this offering is structurally coercive. They are offering shares at $3.50, which is significantly below the newly restated tangible book value of $4.82.
Wow, okay.
And when combined with the upcoming conversion of all Series D and Series E preferred stock into over 22 million shares of common stock, the outstanding share count is going to massively expand.
Dilution on top of dilution.
Right. So if you are an existing shareholder who just watched the value of your position crater, management is demanding that you deploy fresh capital at $3.50 just to defend your ownership percentage against extreme dilution.
That's a tough spot to be in.
It is. You either double down on the turnaround thesis today, or you accept that your claim on future earnings will be permanently diluted.
And what about for someone on the sidelines?
For new investors evaluating BayFirst purely as a distressed asset play, the actionable stance is strictly prove it.
Yeah, I agree.
The Q2 cleanup neutralized the immediate threat of regulatory intervention, sure, but a core operating loss of zero is not a sustainable business model. The execution risk over the next 90 days is immense.
So the smart capital waits for the Q3 earnings report.
Absolutely.
By then, the $43 million in asset resolution noise drops off the income statement. The change in control payouts are finished. The preferred stock conversions and the rights offering will be finalized, giving us the true permanent share count to actually, accurately calculate future earnings per share.
Q3 is when the new engine has to prove it can move the car forward without an asterisk. We need to see clean, localized loan growth funded by cheap core deposits, resulting in positive GAAP net income. Buying before that mechanism is proven operational requires taking on unnecessary risk.
So what does this all mean? We're looking at a financial institution that essentially burned its own past to the ground to ensure its future.
Yeah, that's a good way to put it.
Which leads to a final, profound paradox buried at the very end of the Q2 balance sheet metrics. We spent this entire deep dive discussing destruction, the $32 million net loss, the faked profitability of 2024 and 2025, the 66% collapse in tangible book value. By every traditional metric, this report is a disaster.
Yet, look at the liquidity profile they just reported.
Exactly. BayFirst ended this catastrophic quarter with 80% of its total deposits fully FDIC insured. They maintain a nearly 15% on-balance sheet liquidity ratio, and they reported holding absolute zero in wholesale borrowings. They owe nothing to the Federal Home Loan Bank. They aren't tapping the Fed's discount window, nothing.
Contrast that with 2 years ago. The income statement looked pristine. The bank reported consistent profits and aggressive loan growth. But the capital structure was hollow, the accounting was masking toxic debt, and the balance sheet was propped up by expensive, flighty hot money.
So today, the income statement looks like a crime scene, but the balance sheet is fortified with $80 million in fresh capital, the hot money has been flushed, and the remaining deposit base is overwhelmingly insured and stable.
It's wild to think about.
The provocative thought to leave with today is this. Despite reporting the worst financial quarter in the company's history, the actual systemic risk of BayFirst Financial failing is mathematically lower today than it was when they were pretending everything was fine.
Sometimes you have to shadow the spreadsheet to build a real bank.
Absolutely. Keep an eye out for that Q3 report, watch the dilution mechanics on the rights offering, and as always, keep digging past the headlines.